there is a real economic cost for every ton of CO2 that is released today.
Many people believe global warming is a global scam.
It is costing hundreds of billions per year. Every ton that is released, it causes damages, but it causes them globally. The European carbon market has been reducing at 4.3% per year. We have this guaranteed mechanism that amongst those companies, emissions must decline.
Do people understand how much they're actually paying for this reduction in carbon emissions? And my impression is that no, they don't understand it.
We need higher carbon prices. This probably does mean some impact on inflation. That's just the way it is. There is a cost to do the transition.
Hello and welcome to Capital Horizons, the podcast where money meets politics. I'm Igor Yelnik. My guest today is Michael Azlen, founder, CEO, and CIO of Carbon Cap. Hi, Mike. Thank you very much for joining me.
Hi, Igor. Very pleased to be here.
You manage a carbon trading hedge fund. Can you tell us about what carbon markets are and how they're functioning?
Sure. So carbon markets, there are two carbon markets. There's regulated markets run by governments, and then there is the voluntary carbon market, which is a small, unregulated market. And that's the one that actually most people are familiar with. But we are involved in the government-regulated carbon markets, such as the European emission trading system, the UK emission trading system, the California emission trading system, and a number of others around the world. And these carbon markets have been implemented for two purposes. First, to cap and lower the carbon dioxide emissions in that region. And secondly, to achieve the reduction in emissions at the lowest possible cost. And this second point is very, very important, to achieve the reductions at the lowest possible cost.
All right. But the whole purpose of carbon markets, as far as I understand, is to tame global warming. But many people believe that this whole story about global warming is a global scam. It doesn't seem like anyone denies the importance of human activity in global warming, but people are saying, okay, so there is some impact of human activity, but it's certainly not dominant. Why are we creating markets to tame global warming if it actually doesn't depend so much on human activity?
Yeah, so I began as a climate skeptic. I must be honest. I knew before I even began reading the academic research that the temperature on the planet had varied dramatically over hundreds of thousands and over millions of years. So I knew that there were changes in the temperature well before human beings were on the planet. So I began my research with the scientific peer-reviewed research. And I was fortunate at the time. I had sold my previous business. I could spend 8 to 10 hours a day reading the peer-reviewed literature. It's kind of tough going in terms of the vernacular and the terminology that are used in these academic papers. But over a period of 3 or 4 months, I believe that most people like you and me who make decisions based on evidence, when you have gone through the information as I have, it is overwhelmingly positive. Two things. Number one, the global warming problem is extremely acute, far worse than many people, even who work in the field, realize. And number two, it is most definitely caused by the human fingerprint. And this was really an important thing for me because of this past paleoclimate record that indicated how temperature and CO2 have changed prior to humans being on the planet. But when you study the evidence in this regard, it is undeniable that it is the human carbon dioxide, most of it emitted since 1950, that has increased the concentration in the atmosphere from 280 parts per million now to 430 parts per million. And we understand what carbon dioxide does. It's a warming gas. It simply traps infrared radiation. I certainly came from a position of being a skeptic. I actually spoke to some of the leading scientific skeptics of climate change because I really wanted to understand the other side of the argument. Again, I encourage readers to do their own homework. It is time consuming, but there's nothing like, doing the research yourself to reach a valuable conclusion. So, the impact, we're seeing global temperatures rise. The economic impact, if we put to one side the moral and ethical, which is very difficult to do because the poorest countries in the world are being impacted the worst. But if we put that aside and we simply look at the economic impact, it is costing hundreds of billions per year in terms of damages and losses, loss of labor productivity during heat waves, et cetera, et cetera. So as a capitalist, there is a rational capitalist cost of warming, and therefore every ton that is released is an externality, as economists would call that. It's an externality. It causes damages, but it causes them globally, right? It's a well mixed gas, carbon dioxide, so it quickly disperses around the planet, and therefore this brings lots of problems, like the free rider principle, where some countries can say, "Well, I'll let other countries cut, and we won't cut our emissions." But of course, we did have the breakthrough with the Paris Agreement in 2015, and we've made progress since then.
All right. So many questions which I have based on what you have just said. To begin with, mostly this is not a problem now. It's going to become a big problem going forward if the current trends continue.
That's not true. The economic damages only in the last 5 years, only just in one country, the United States, are in excess of $1 trillion US dollars. If you take the not the total damages from extreme weather events, only the proportion that scientists can calculate is due to warming activity, because we can't say that every storm is due to climate change, but it only increases the probability. But there is mathematic and statistical ways now where we can say what is the cost today. Academics call this cost of releasing these gases, they call that the social cost of carbon. And recently in the US, when the government tried to calculate this, they calculated a number at $190 US dollars per ton. So that's one number. There is no magic number, but there is a real economic cost for every ton of CO2 that is released today. It is going to get worse in the future, Igor. You're right, much worse for our children. But today there is a real cost.
All right. But today, the reduction in greenhouse gases is happening in the developed countries. But we know that about 30% of all emissions is coming from China, quite a lot of coming from India, which is the third biggest polluter. The second is the US. And then we have the European Union, which has done quite a lot and is doing quite a lot to reduce emissions, and then Russia. And if we speak about these three, China, India, Russia, China is doing a lot. We also know about it. Nevertheless, according to Paris Agreement, China has not committed to reduce the actual level of pollutions. China has committed to reduce the intensity, which means that as long as their GDP is growing, the absolute level of pollution may also grow. I mean, the emissions are still rising, the temperatures are still rising, and I'm not seeing how this problem is actually being solved.
So I think you're absolutely right. Paris Agreement 2015, 194 countries agreed to try to limit warming to 1.5 or 2 degrees, two different targets. What is interesting is that since 2015, in every subsequent year, global emissions have increased, except for 2020 and COVID, when we had a bit of a retracement. But in every single year, global emissions have increased. So we have been going in the wrong direction, which is why the situation is getting more desperate in terms of us having to take action. What's interesting is that we can now statistically calculate what is the remaining carbon budget? How much can we release before we breach the 1.5 degree threshold and the 2 degree threshold? And why are these important? Why has the IPC said we should really try to limit warming below 1.5 or 2? They're just numbers. The reason is, and again, well-founded research indicates every tenth of a degree we warm, and we're now at 1.2 degrees above the pre-industrial average, every tenth of a degree contributes to triggering feedback mechanisms on the planet where the natural systems of the planet move from being sequestering carbon dioxide to emitting carbon dioxide. And there is a worry that once we go through 1.5 and certainly 2 degrees, that we could be in a position of runaway climate change where even if human emissions went to zero, the planetary emissions would continue and we would continue to 3 degrees, 4 degrees and beyond. And that becomes an existential issue for the human species at that point. So it is important, these 1.5 and 2 degree thresholds, and we can calculate how much more carbon can be released. There's a couple books out on this, and obviously a lot of academic work. There's been a recent paper just released which indicates we have about 5 years of our current run rate of 40 gigatons, 40 billion tons per year. It's kind of the current run rate, 36, 37 billion tons. We have about 5 years of this run rate before we will release and use up the 1.5 degree budget, and then perhaps another 18 years before we breach the 2 degree carbon budget. So we require quite dramatic reductions in CO2 emissions to stay below those thresholds. The IPCC and most people, Igor, now, they recognize we are going to overshoot. So we're going to shoot through 1.5, hopefully not 2, and then we have to come back. And the only way to come back is through carbon dioxide removal. So the carbon dioxide removal, or CDR industry, is going to become massive in the coming decades. It will be an enormous industry to remove CO2 from the atmosphere, to bring it from this 430 parts per million back down, maybe not to the 280, but around 300 or 330 parts per million, so that the climate system on the planet can stabilize.
But what you're saying basically means that we're facing an engineering problem. And if we know the cost, we know how much we can invest to solve this engineering problem. What other solutions of this problem have been considered? And why do you think that removal of carbon dioxide particles from the atmosphere is the best?
Yeah, I certainly don't think that removal is the best. Emission reductions are what is most urgently needed. So we need to transition the economy to a much cleaner fuels and much lower emissions, and we need to do this very rapidly in order to prevent triggering these many tipping points. So that is the whole principle behind a carbon market. When I was at the LSE studying in the climate program, we studied all of the mechanisms that governments tried around the world to bend the curve of emissions down. Almost nothing worked, Igor, except for one mechanism: carbon pricing. In a market-based economy that respects supply, demand, price, and profit, you must interact with these four levers in order to have an impact. And by putting a price on emitting carbon dioxide, then we see an impact, because corporations incorporate that price into their cost curve, and they will choose to another source of fuel if the emissions from the current source are too expensive. And we call this abatement. And the way the carbon market works, in Europe, for example, the 7,000 largest emitters, steel companies, cement, oil refineries, power generation. Power companies burn, of course, coal and gas to make electricity, big emitters. So each of these companies must, under the carbon market, if they emit 3 million tons in a year, at the end of the year, they must give the government 3 million permits. Now, the government controls the supply of the permits, and it issues an annual supply with a cap. So across all of Europe, the total permits are 1.35 billion. This is the cap. Emissions cannot be higher. So 1.35 billion permits are emitted. Companies buy the permits. At the end of the year, the government audits each company, and the companies then give the permits back to the government. The government receives the permits and they destroy them. And this year, this compliance year, is now completed. The next year, the government issues 1.3 billion permits, then 1.2, then the next year 1.1. And since 2005, the cap in the European carbon market has been reducing at approximately 3% per year. Now it is reducing at 4.3% per year. So we have this guaranteed mechanism that amongst those companies, emissions must decline. So this is how the carbon market works. So every CEO looks at the permit price, which today is about 70 euros for every ton of carbon dioxide, and they look at their internal price. What is my cost? This is your solution, Igor. What is the cost to cut my emissions? And if the cost is 60 euros, but the permit price is 70, if I am a profit-seeking CEO, I simply choose to pay less and make more profit. So I cut my emissions. And this is the magic of how the emission trading system achieves the second objective, which is, I always say, the three magic words: least cost abatement. Abatement means to reduce the emissions. And we want to reduce, but we want to reduce at the lowest cost. And so the carbon market is the invisible hand across 7,000 companies in Europe. Which company has the lowest cost? They choose, they self-select by internalizing the carbon price. They internalize the price and they choose to cut their emissions. So, of course, if the permit price is 70, if you have a company where the cost is 200, they don't cut. They simply buy the permit. But if your cost to cut your emissions is 40 euros, then I pay 40 and I reduce my emissions and I do not buy the permit and give the money to Brussels, to the government. So this triggers these magic words: least cost abatement. When we lower the cap every year, we can be quite confident that it is the companies that have the lowest cost of cutting their emissions. Indeed, they are the ones who self-select and they cut their emissions. And in Europe, emissions have dropped 1.1 billion tons per year. That is the change in the annual run rate since the program was launched in 2005. And 75% of that drop has come directly from the companies under the emission trading system, the carbon market.
The problem with this idea is that if I am a CEO of a company which emits too much of CO2, then one possibility for me would be to actually reduce the emissions. Another possibility is to move my production to another country where the cost of emitting CO2 is significantly lower. And we have seen this happening, and this is going to continue. So yes, there have been great results achieved in Europe, but at the same time, Europe has been losing its production base.
So just to comment on this point, because this is very, very important. This is called carbon leakage. That's the academic term for this, and this has been studied quite intensively in Europe. And the answer is there has been up till now very, very little carbon leakage. And why is that? If we look at how the carbon market works, it only covers the big emitters. The threshold is 25,000 metric tons per year. So again, it's power generation, steel, cement, chemicals, oil refineries. These are large industrial pieces of kit on 10 acres, 20 acres. Very expensive to lift this factory, move this factory, and put it down somewhere else. So the cost is too high to geographically, physically move and carbon leakage. However, you bring up a very good point, because as the carbon price rises, the incentive to move becomes bigger. So Europe has now implemented the Carbon Border Adjustment Mechanism, the CBAM. And the Carbon Border Adjustment Mechanism is designed to create a level playing field between emitting carbon in Europe and emitting carbon outside Europe and exporting your product into the European Union. So beginning next year in 2026, any steel or cement that is exported from outside the EU into the European Union, this will be hit with a tariff equal to the embodied carbon emissions in the product. And this will be phased in from 2026. And the idea behind this is to create a level playing field between a steel company in Europe, who must pay the carbon price, and a steel company, for instance, in Turkey, where there is no carbon price. Now, when Brussels announced this tariff in Turkey, very quickly, the Turkish government announced, we will launch a carbon market in Turkey. Russia announced, we will launch a carbon market in Russia. Because they're green? No. They realized Turkish steel and Turkish cement is quite a big export into Europe. The tariff would be levied on the steel, and the company would pay the money to Brussels. But Turkey said in Ankara, no. We have the carbon market in Turkey. We will charge the carbon price, and we will take the revenue in Turkey to address climate change. And then when the steel gets to the border, they will only be charged the difference between the European carbon price and the Turkish carbon price. So there's been a whole number of countries now, Igor, since Europe implemented the CBAM. Many countries are launching carbon markets. You mentioned China. China launched their carbon market about 4.5 years ago. South Korea has launched their carbon market. Japan is launching next year. Philippines, Malaysia, Thailand, Vietnam, all at different stages, and India and Brazil, two of the biggest emitters, are both moving legislation through to launch their own carbon market. So we're seeing a big growth in this concept of putting a price on emissions, I think because it has been very successful in Europe. It's been very successful in the state of California. And my hope is that we'll see, more coverage of emissions. Currently, about 20% of global emissions are covered by a carbon market. So we have a long way to go.
Yes, but practically speaking, we're speaking about an additional tax, right? And this tax creates some inflationary pressure. Do we know how much of inflation is explained by the introduction of this tax?
So there's been some interesting work done by an academic called Pardo, who has looked at in Europe the relationship between the carbon price and inflation. And what they found, you're quite right, the imposition of a carbon price on steel and cement and electricity, it flows through to the end consumer, and it does impact inflation. But we must always remember that cost that is being paid to reduce emissions has a direct impact on the economic loss and damages from climate change itself. So what one has to be realistic and factual to say that when a ton of carbon dioxide is emitted, there is a real economic damage to that 1 ton. If I do not remove the ton, it costs money, but then we take away the damages function. So I think it's very important to keep this equation in balance when one is thinking about this. But there's no question that in order to meet our objectives, we need higher carbon prices. This probably does mean some impact on inflation on a flow-through basis, but that's just the way it is. There is a cost to do the transition.
Yeah, but the question is, how big is this cost? Do people understand how much they're actually paying for this reduction in carbon emissions? And my impression is that the answer is no, they don't understand it.
Well, one of the really smart and I think elegant features of a carbon market is the following. So the government sells the permits every year, and normally these are sold at an auction. So the government auctions the permits. In Europe, there's an auction every day. And this raises hundreds of billions of dollars of revenue into the government. In Europe, 100% of these proceeds from selling the permits are segregated and reinvested into energy efficiency and low carbon initiatives. So it's very smart because first, we want a carbon policy that is stable and sticky, that politicians don't move. Taxes can be put in and put out. A carbon market tends to be more stable. The revenues, politicians love the revenues. They love to do a new ceremony where they put, solar panels on the roof of a big building and they have a ribbon cutting. So I think this is another very important element of how a carbon market works. All of the revenue generated, it might cause inflation, but it's all of it reinvested into energy efficiency and low carbon initiatives. And the fourth benefit, Igor, if you are a scientist or an inventor and you are working on low carbon intellectual property, if you bring your IP to a venture capitalist, you say, look, I have this new scrubber, more efficient technology for scrubbing CO2 at the factory. If this conversation is happening in a carbon market where there's a price on carbon, you will get the financing from the venture capitalist because they can see a pathway to monetize the IP. So a carbon market provides, number one, cap and lowering the emissions. Number two, it achieves the least cost reduction. Number three, all the revenues are recycled. And number four, it stimulates low carbon intellectual property development. And I have to say, I've studied all of the climate policies that have been, implemented by governments, and this is by far the most successful and the most elegant and powerful.
What about the political effect of this? We know that, like solar panels, car batteries, they rely on rare earth elements and on metals. The majority of them is available in three countries. It's China, Australia, and Russia. China and Russia, they have geopolitical interests, which are so different from the geopolitical interests of Europe and the United States. And nevertheless, we're relying on these countries to supply those materials to us.
Yes, no, I agree. But in terms of China has control of a substantial portion of rare earths. These are essential not only for battery technology, but some of the rare earths are essential for other key technologies. So it is a concern. Hopefully that this will work out. Supply and demand intersect at price, and price usually that's where the market clears. So we may see, we saw a big spike in lithium prices, and then a lot of supply came on the market and the price collapsed. So sometimes a high price is indeed the cure for high prices. Certainly, China is moving far ahead of the United States and Europe in terms of the scale and development of clean technology. The scale of solar, wind, nuclear, long distance grid, battery storage, industrial battery storage. China's moving very, very fast and has a real lead in all of these key areas. And that is somewhat of a concern, I think. And China is doing that not only because they do have an outlook for clean air and clean water in their country, but it's a geopolitical security concern. They import a lot of oil and gas, and therefore they want to have energy security by having domestic solar and wind and nuclear clean technologies where they don't require those imports. So, yeah, geopolitics is interesting, but China builds more solar and wind each year than the rest of the world combined. That's how enormous the production is, and it's just incredible what's happening there. You mentioned their emissions, their carbon market is an intensity-based market, but several experts now think that China, instead of their objective of 2030 to peak emissions and bring emissions down, they may have peaked this year or next year. And so, China's a strange one because they're building more coal than the rest of the world combined, but also more, solar and wind. But it's a large and fast-growing economy, but they're certainly taking the lead in clean energy.
This is about the usefulness of the carbon markets and whether they actually help with the climate change. There is another aspect of it, and I think this is what you do day in, day out. You are trying to make money out of these markets. How do people make money out of carbon markets?
Yeah, so when I first learned about carbon markets in 2018, Igor, I looked at the markets that were trading at that time, and they were trading about 10 billion US dollars per month, and most of that liquidity of these markets was trading in the exchange listed futures market. So, like other commodities like oil or gold, most of the liquidity trades in exchange traded futures. Um, I was curious about the statistical properties of this. This is a liquid asset class. What is the historical return of carbon, the volatility, the correlation? And I could not find any research. So I hired a PhD student from the LSE. Together, we built a proprietary total return time series for each carbon market. And we analyzed that data and we wrote up a full academic paper. It took 3 years in the peer review process, but the paper was published in 2022 in the Journal of Alternative Investments. And it throws up some very interesting statistics. So, um, carbon markets as a portfolio in the last decade have generated double-digit returns, annualized returns. So they have outperformed the S&P, most commodities, and most other asset classes. So that's a passive investment. And when you understand that over time, the supply of carbon is reduced by the government, but demand may fluctuate with the economy, the objective is for the regulator, for the government, higher prices. Because every time the carbon price goes up, someone cuts their emissions instead of buying. Then the price goes higher, someone else cuts their emissions. So the key point in understanding this asset class, carbon, is that the long run trajectory is up and to the right. Now there's there,
Until you kill the economy.
Yeah, when you have, it is a pro-cyclical asset. So in a booming economy, lots of steel production, lots of electricity, more emissions. So the demand for the permits goes up and the price goes up. In a recession, um, steel and cement and electricity consumption are down, lower emissions, the carbon price, less demand, carbon price falls. This is another, I think, smart shock absorber for the carbon price because when we're in a recession, we want a low price for these companies. They're struggling. We don't want to make them go bust. So the carbon price moves up and down with the economic cycle, but the long run trajectory is, for ultimately a higher price. And the question is, how high? Now, if you look at the leading experts in the field, they estimate by 2030 that we need a carbon price of approximately 120 US dollars per ton by 2030. And if we get the carbon price to that level, this would stimulate enough reductions to keep us on track for the Paris Agreement. So, where's the price today? If you look at there's carbon indices, S&P has a global carbon index. That index had a price of about $60 per ton at the end of last year against a 2030 2030 target price of 120, so about a doubling of price. And that works out to about, if you just buy passively carbon today at 60 and say, I'll just hold it, if it reaches 120, this is a 13% annualized nominal return, or about an 8% risk premium, academically speaking, above the equivalent risk-free term match treasury. And we certainly think that a passive exposure to carbon makes a lot of sense. As you mentioned, we run an active approach to add alpha in addition to that, but just a passive approach. It's liquid. It has this reducing supply, very attractive features, and it's a very green asset to own.
All right, but you are you are adding some active element to it, right? Because otherwise you wouldn't be needed. Everyone can buy futures. It's not too complicated. In addition to this passive component, how do people make money in this market?
So there's a variety of strategies. What we did in a nutshell, and is we used our proprietary time series data to test statistically a number of factors. And when we found something that was statistically significant at predicting carbon price changes, we have incorporated that into a quantitative multi-factor model. So we have a very quantitative process. We have two very different strategies. The first strategy is the core, and the core strategy aims to capture that long run risk premium. So we are long biased in the core, but we hope to add some additional tactical alpha on top of that beta, if you will, in the core. And then we have a second strategy, which is called alpha. And alpha is much more like a short-term CTA, if that is something that listeners are familiar with.
So
We
it's
have
trend
about,
following strategy, basically.
I would say short-term CTA, more combination of short-term trend and mean reversion. We have four buckets there. The first is arbitrage. So we arbitrage the daily auctions. The second is short-term directional, classic CTA, trend and mean reversion, but short-term. Third bucket is relative value. And the fourth bucket is the carry. So we combine a core strategy with an alpha strategy, very quantitative and very systematic.
Out of curiosity, what is carry in the carbon market? How do you define
So,
it?
so like in other commodities, you have the price of the physical commodity, and then you have the futures price. And in most commodity markets, depending on the cost of storage, the futures trades at a premium to the physical commodity because you don't have to put out the cash. So it's the cost of carry, the cost of capital until the futures contract expires. When the future trades at a premium, that's called contango, and the carbon markets are all in contango. So there's a premium. So if the physical carbon permit is trading at $70, the futures price maybe trades at $72. And this $2 represents the physical cost of carrying the position until the expiry. So let's say if you bought the physical and shorted the futures and you wait until expiry, they converge and they deliver into each other. So it naturally unwinds automatically. And you would earn the $2 spread, which would be equivalent to the T-bill rate. So in most carbon markets, the contango premium is equal to short-term interest rates, but in some, like the California market, it's substantially higher. So there you can put a carry trade on where you earn substantially more return than the equivalent term matched fixed income rate.
Uh, okay, but is the spot market, the physical permits, whatever is the analogy for physical commodity, is this also a liquid market?
It does trade OTC, so there is liquidity. And in order to hold these permits, you must open a registry account with the government in each carbon market. We have these registry accounts, and that allows you to hold the physical and to take delivery and make delivery using the futures contract. If you hold the futures until expiry, you make delivery or take delivery, like in other commodities. Of course, carbon is a digital asset. So, 1 ton certificate sits in your registry account. So you log in, highly secure login, and then you see how many tons of CO2 permits you have in your registry account. And in the fund, we only hold three instruments. We hold the permits, physical permits, we hold futures and options, everything daily liquidity.
Okay, interesting. I have learned a lot today. Thank you very much, Mike. It's been a very interesting discussion.
Thank you, Igor. Bye-bye.
Thanks for listening. This has been Capital Horizons.
So if you would like to see or learn more about Capital Horizons, please subscribe below.
From Michael and I. See you next time.